Welcome back. Let's get to the market and the way forward. Mukul Kochhar from Investec Capital Services is now with us on the show. Mukul, thank you very much for joining in. I remember our last conversation was just prior to the election verdict day, or a couple of days prior to that, and we were discussing what happens, the various scenarios. Well, since that's played out, we've seen the market skyrocket from levels of 22,300. We're now at 24,500 plus. It's just in the last few days, markets appear to be consolidating. What's the call now? What's the strategy? How you see the setup?
Thanks a lot for having me, Reema. So, election was what it was, right? So it's firmly behind. The good thing is that we have some continuity, and the government is, messaging that continuity. So that's at least, positive for the markets. Now, going forward, therefore, most of our calls remain the same. We have been running three themes prior to the elections. Actually, since last year, we continue running those. One is we believe that we will get into a current account surplus situation, which has implications both for growth and the currency. The second is we believe that there will be a strong private Capex cycle over the next few years, which is derived from our analysis of very, very strong and solid corporate earnings and a substantial gap between earnings and current Capex. We believe that Capex will move towards corporate earnings as it has in the past. And third is our call on discretionary consumption, which honestly, that's probably one thing that changes with elections, where we think the discretionary consumption will come out fast. So our portfolio construction is around this. We believe earnings growth will follow a formula of roughly 10-11% earnings growth, a little bit of margin expansion with roughly 14 to 15% PAT growth. So the market seems pretty okay. There is fluff. There are concerns brewing a little bit on the horizon as well. But sector-wise, if you do sector selection, I think you should be okay in the market.
So just particularly on that theme of consumer discretionary, well, some pockets of it are showing some signs of weakness. Titan, for instance, for 2 quarters now, even their current guidance is talking about pressure. Asian Paints, this is the second quarter where we've seen a decline in their, revenues. So is there some stress emerging, at least in pockets of consumer discretionary?
Yeah. These are specific stories as well. While I won't delve into a call on specific stocks because compliance restricts me, but if you look at some of these stories, competition is really hitting hard. There are new entrants, and the companies have had to repivot, themselves to, face up with those new entrants. And honestly, some of these stories will be structurally challenged, and people will rethink the kind of multiples that they've given them in the past. Having said that, if you look at the auto sector, which is what we're really, really bullish on, the entry valuation is not so aggressive, was not so aggressive. Some of these companies have posted very, very solid numbers, which honestly led our analysts to upgrade earnings on report. And that's where we will focus more. I think the auto sector is really, really well positioned as a consumer discretionary place. Some of these, other stories that you mentioned may have some dynamics going around with new competition coming into the sector.
Mukul, hi. So where is IT in the scheme of things? Good to have you on the show. So just wanting to understand where IT is in your overall scheme of things, because this is the first time that we're not seeing disappointment from many of the companies. At least the commentary is not as bearish, numbers are not as bad. Don't want to jinx it. Let's see what Infosys says today. But most portfolios either are underweight or neutral on IT. What would your recommendation be, looking at the way things are shaping up now?
You actually sort of said it very well. Lack of disappointment and sector rotation and the sector ripping. Having said that, it's still a sub 10% revenue growth sector. I mean, especially when you look at it in the context of our call on, the rupee, we think current account is going to sort of become surplus. Secondly, if you look at where the US is going, there is already concern around the economy. Calls for reduction in Fed rate, which had gone on the back burner. They're back in. And those are things that you have to consider when you consider investing in IT services. These are not, even if you look at the margin going forward, we are already projecting, street estimates are already projecting peak margins. So they're 10% or sub 10% growth stories, and you have to consider what multiple you give them. Very, very high quality businesses, but I think they've already sort of reached peak multiple. Lastly, you have to consider what's going to happen to US politics. Last time, the expected dispensation was in power. IT sector was a big bargaining pawn for trade concessions, and I firmly expect that those discussions will be back on the plate next year. So if you're slightly forward-looking, at least even 6 months, I wouldn't be piling into the sector now.
A quick word on banks, where we're getting some mixed views. Some believe the peak performance is behind them. Others believe it's gone through a long period of time correction. It's got to perform. If India is doing well, how can the Indian banks not shine? So where do you stand on banks?
Yeah, banks, I'm very constructive. Of course, there's some specific stories, and you have to be careful in stock picking. I have, on the asset quality, if you look at the corporate side, really, really sound. Consumer, we are saying, is probably going to get better post-COVID hits that the consumer took. Credit growth has picked up. Formal job creation, I think, will pick up as well. And finally, on valuations, right? This is one sector where I don't sort of see stretched valuations at all. So banking, very positive. Going forward, it's also a large sector which allows us to remain constructive on the market overall as well.
All right, fair enough. Got it, Mukul. Thank you very much. Appreciate the views, and thank you so much for joining us today. Well, with that, we do have to take another quick break. We will come back on the other side with a really interesting story. SEBI is looking at allowing asset managers to now come up with a brand new asset class, something that will sit in between mutual funds, plain vanilla funds, and PMS, portfolio management services. What does this mean? What does the consultation paper say? And what's the industry's reaction? We'll ask Mr. DP Singh, Deputy Managing Director and Joint CEO at SBI Mutual Fund.